Good morning, everybody. Welcome to the Hardcore Mortgage Real Estate Business Podcast. Today is Wednesday, April 27, 2022. I am joined by Becky Alley, top 1% of all originators in the United States. Good morning, Becky.
Hey, what's up, everybody? I can't believe it is the end of April. Stop it.
Well, Becky, I can't believe it's the end of April, considering it was below freezing this morning when I went out to walk the dog.
I can't.
So I think we live in the North Pole is what we're doing. John Kolb is with us this morning, Becky. John Kolb joins us. Looks like he is, John, are you home or in the office? I can't tell.
I am home right now. I'll be in the office as soon as this is over.
John Kolb, too, is part of the top 1%ers in the United States. Welcome, John. And with us again is Mr. Harvey Freed, host with the most, Hardcore Mortgage Real Estate Business Show in the mortgage banking industry for over 30 years. Mr. Harvey Freed, good morning.
Good morning, Harry. I've got some definite hardcore information for our show today.
Excellent. I appreciate that. And this show is always brought to you by Capital Mortgage Funding, powered by top 10 lender in the United States, Fairway Independent Mortgage Corporation, equal housing lender. Roberta Beauchene in the booth. I'm going to start out with you, Harvey. Harvey, what breaking news do you have for us this morning?
Well, Harry, I hate to report this back to the real estate community. More importantly, we knew this phenomenon's been going on. It's a bad thing. People that aren't truly approved, clients that are not truly approved, who have approval letters from fly-by-the-night mortgage, trunk of your mortgage company, as we would say in the past. Companies that you see on TV. You know, everything you see on TV is not necessarily true, Harry, and everything you hear on the radio or on a podcast might not be true. So we always challenge our clients and any of our listeners to check us out, to come and meet us in person to find out if this is real. Because, Harry, I got a bad call from several real estate agents, and two in particular this morning, that they have no deal closing. And there's about 3 other deals that are attached to this one deal because the buyers and the offer they took were not properly approved. They are not getting a mortgage. Harry, you can't get a mortgage for $300,000 if you only make $25,000 a year. And if you can, I don't offer that loan.
Well, Harvey, this is a good segue. So good segue. I let you rant a little bit. All the rage right now, panel, is that we're skating close. This is a quote by a guy who wrote this article. And by the way, I have very definite thoughts on this, so I'm going to contain myself. And I'm going to let the panel go first. All the rage is that we're skating very close to another housing bubble. Well, panel, as Harvey just mentioned, plenty of approvals out there, plenty of people that want to buy houses. Becky Alley, what's your thought on us skating very close to another housing bubble at this point in time?
Okay, so I definitely have some serious thoughts on this. And the answer is we are not skating towards another housing bubble. There is a lot of cash flowing around in these homes right now. These are not artificially inflated appraisals based off of calling someone saying, I need to hit this number. What's happening is these appraisers are bringing them in at, let's just say 200,000. And it is the buyer's discretion that they are choosing to bring an extra 40, 20, 10, whatever it is above these appraised values. So in theory, yes, is this homeowner potentially putting themselves in a negative equity situation by doing that? Should the housing market kind of settle down a little bit? Absolutely. But that doesn't negate the fact that these are a bunch of bad loans out there. So, I mean, I guess you can define what kind of housing bubble are we talking about. If we're talking about the 8, 9, 10 housing bubble, absolutely not. This is not the same thing. These are consumers are assuming the risk. The lenders are not. There's a lot of cash flowing around, and these are well-qualified mortgages. And like I said, there's a lot of cash flowing around this. You know, right now, people have a lot of equity in their homes. So even with these appraisals going, or these home prices going through the moon, because there's a lot of cash flow, it's also equated to a lot of equity in homeowners that are currently owning homes that are pulling cash out to make renovations. So it's a different animal. This is not going to be the recession that we saw, you know, and I understand, I'll never forget that. I was a mortgage lender during that time, and it was scary. I had to totally reinvent myself. I was only in the mortgage business for 4 years at that time. Well, fast forward it 18 years later, and here I am, and we're in another tough market. But guess what? This isn't my first rodeo. It's not Harry's first rodeo or anyone else's that's on this panel's first rodeo. We know how to handle tough markets. And like Harvey was saying, also, we know how to get loans closed and properly approve them.
Very well said. Very well said. John Cole, what are your thoughts on, are we in a skating close to another housing bubble?
No, I mean, Fannie and Freddie wouldn't have increased the minimum loan limit for jumbo to conventional, or from conventional to jumbo, I should say, if they thought that there was going to be a crash. And their economists are way smarter than ours. So
what are you saying, John?
I'm sorry.
Come on now.
Becky Alley, chief economist for Capital Mortgage Funding.
Yeah. Right here.
Well, John, there are plenty of lenders that throw that moniker on their people sitting in the office next to the guy that's running the show. They call themselves chief economists for blah, 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 blah lender. So, I'm sensitive to that too.
I'd love to see their credentials. I mean, if their credentials are that they went to Walsh College of Business and that makes them a chief economist, then okay, go for it. Yep, I'm going with it, Harry. And, it's just one of those things that, there's smarter people out there than us. We have to listen to what they have to say, decipher what's the BS and what's not, and move on with our theories. And my theory, like Becky's, is that no, we are not close to a housing bubble.
Yep, I agree with that. Mr. Harvey Freed, you pontificated on the fact that you've got a lot of buyers that are getting pre-approved that really shouldn't be pre-approved, but there's still not a lack of buyers in the market. So, Harvey, in your opinion, are we skating close to another housing bubble?
No, but the pre-approval buyers that seem to be starting off 2022 do have a little bit more. We used to say hair on their chest or hair on their head. There's a little stickier files out there. The year started with it appears that a lot of the clients that are self-employed now are interested in home ownership. Maybe the last couple of years of appreciation has gotten them to say they don't want to be renters anymore. But the truth of the matter is, Harry, they're not dealing with qualified lenders. They're not dealing with qualified real estate agents that are willing to ask the tough questions, gather the documentation that's required to get a mortgage so you can complete a transaction. This is unprecedented, Harry, that I've ever seen a year start off with at least, personally, 5 to 7 transactions that were brought on from other companies, and they're not qualified. They're simply qualified. We can't save everybody, but we have been able to save a few of them.
Go ahead, Beck.
Yeah, so I wanted to kind of what Harvey's talking about is what is going to happen is a bad lender and bad real estate agent bubble is going to happen. That's going to burst. Right now, a lot of people are being exposed, what Harvey is talking about. So when the first housing bubble, since we're going to stay on this topic, right? The first housing bubble happened, there was a weeding out process. There was a lot of bad lenders out there, and it would kind of force their hand to get out. And a lot of bad real estate agents, not that they were bad, but you couldn't be part-time and make it. Like it was tough. It was a tough market. So a lot of people got out of the business, right? There's going to be some of that happening again. It's already happening. We've been in a refinance market the last 8 years. Okay. Hooray. Now you have these situations where it's not exactly a refinance market. It's an experience market. You need to align yourself with someone that's experienced. So what's happening is these inexperienced lenders are being exposed, and they're going to get weeded out because they're not going to be able to hack it in a tough market like this because they don't have the experience that it takes to qualify people for purchase transactions. So it's already happening. There's a lot of shops that are closing up. So I do think we're going to see that kind of bubble where we're in a weeding out process. I'll take this market all day long because it creates a separation between who knows what they're doing and who's not. And you put me in a room with someone that Harvey's talking about all day long, let's rock and roll, because you're going to see the difference. You're going to hear the difference, and you're going to feel the difference from all of us.
That's right.
Yeah, I'm pretty jacked up about this topic as well. Is the overall market inflated? Of course it's inflated. We believe it's inflated. People making outrageous offers on homes, but they're doing whatever they have to do to get the house. Okay. Are houses overvalued? Well, what's the definition of overvalued? I mean, right now there's an article saying that year over year, from last year to this year, prices are up almost 20%. Is there a crash going to happen? No, there's not going to be a crash. Is there going to be a settling down period? Sure. Harvey mentioned unprecedented. He used the word unprecedented the first part of the year. What is unprecedented is that the rates have gone up in less than 3 months, 2 full percentage points in less than 3 months. Last time it happened, 1994 to 1995, rates went up 2 full percentage points, but it took 12 months. Mm-hmm. So there will be a settling down. There won't be a bubble. There won't be a crash, but we will see a settling down period. Now, home prices being 20% up same time last year, Becky. Why? Why is that happening? Well, it's pure simple. There's too many buyers for too little homes, right?
Yeah, absolutely. I mean, and the thing is that just it's predictable, right? You have the same people that are wanting to even try to refinance right now that we're telling you, saying, no, I'm going to wait till they go down to 2% on a 30-year fix, right? Or 1%, right? Those people sat on the fence and now they want to come out and be like, oh, I missed the boat. I'm ready to refinance now. It's that same thing. You're trying to sell a stock after you already lost its money, but you can still work it out. It still makes sense, because if you're paying 5% on a mortgage, I will never understand why it was okay for you to pay 29% on your credit card. And to that point, just real quick, I was talking to my grandma about this, right? So my grandma's 85. She started laughing literally in the middle of a conversation. And she laughed and she was like, 5%, because she's from the South, right? She's like, 5%. She's like, my mortgage was 12%. That ain't nothing, right? So it's all about perspective. And the housing prices, they are going to settle down because there's a shortage right now. It's supply and demand. We talk about this all the time. So, maybe we're not going to see these $40,000 over asking here in the future, but we got a long time before this supply catches up with the amount of buyers that are flooding the market because they feel like they sat on the sidelines too long and they know they're going up. And now it's just the floodgates are open and everyone's trying to buy right now.
Yeah, I love it. And I love your grandma. I'm going to go to John Cole, but I'll say it before John does. John, home prices up nearly 20% from last year. Why? Same story, short of inventory, supply and demand issue. Becky's talking to her grandmother who's 85. Yeah, I'm pretty close to that, John. There you go. I got it out there. I'm close to 85. I hope to reach 85 like Becky's grandma. Will prices stabilize and when, John? Will they and when? I got to know from you. Talk to me.
I mean, of course they're going to stabilize at some point. Do we know when? No, I have no idea. I mean, I'd like to see the data on if there was no housing burst in 2008, 2009, and we just used 5% appreciation on those homes, because I know that my home tanked like crazy in that period of time. So had my home not tanked, where would the values be if we just went 5% each year? Maybe this is just a correction from that period of time. Who knows? Some nerd out there knows that data. So if you're a nerd and you got that data, give it to us. And
you 5% over the next 10 years.
Wait a minute, John. I'm a nerd, and all we got to do is go back to 2008 at 5% for the last 14 years. We can do that.
Well, we found our nerd.
There we go.
And so, yeah, I'd just like to say maybe this is the correction from the housing burst bubble. So will it settle down? Of course it'll settle down. It'll probably settle down in the next year or two. And, and we'll be back to normal. People will be back. Sellers won't be able to, run the show on everybody like they are right now. And the buyers will be more affluent. And so you might just have to wait it out a couple of years if you're waiting on homes to become available. But if you can't afford something at 5% because you only could afford it at 3.5%, then you shouldn't have been in the market anyways.
They just got to readjust their sales price, what they're looking for. But the thing is that with the way these homes have inflated, right, what the house looks like at $100,000 now is really is what a $50,000 house was looking like, so that's why it's a little tough for these buyers out there right now.
Yeah. Hey, Harvey, new home sales for March declined. Well, that's pretty easy to figure out because they can't go at a record pace every single month, right? However, the good news is sales continue to run above pre-COVID levels of before March 2020. So that's good news. Again, familiar theme. Plenty of buyers out in the market, the general trend is positive on the home buying space, right? So really, if you're taking a look at the areas that we do business in, which is pretty much the entire country, are there inflated areas more than other areas? Of course. But Harvey, you've been to closings all week, all month. The vibe out there for buyers in terms of where the market's going is it's really an inventory problem that continues to plague the new purchase market, right?
Yeah, I was out yesterday, Harry, and you're right on new construction, definitely new home sales for the month of March. Numbers are a little bit down, coming right out of the winter months, where it's been about supply chain and getting the lumber prices down. But again, there's been hardware and a lot of the components inside of the house that have delayed some of the closings. I think we'll see new construction numbers, they're not going to look like they did the last year or two, but they might look similar to 2019 numbers. But on the east side here in Michigan, as I can tuck in our backyard, I drove by at least 3 or 4 brand new construction sites. So they can't build them fast enough. Again, the fact is there's many buyers out there. Certain pockets around the country, Harry, like you said, are a little overinflated. There's not new construction subdivisions, not a lot of them that are affordable in our county, in Oakland County. We're seeing really on the high end, it looks like 600,000 and above for new construction, where some of the other counties around town are starting at about $300,000 point price, but cannot build enough homes to satisfy all the buyers out there.
Yeah, as I said, Becky, the general trend right now is positive, still a seller's market out there. Housing, demographics, buyer population, of course, interest rates. What does all that mean? That just means I'm a nerd. I like numbers. And John, I was around in 1979 through 1982 when the Fed was raising rates to combat inflation, which sounds like the same thing that's going on right now, Becky Alley. But you know what the difference is this time? The difference this time is rates weren't going from 10 to 18%. Rates are going from the 3s to the 6s. Still plenty affordable. And the fact that there are more buyers in the market now than then because we have a population increase in the baby boomers kids, which are called what? Millennials, people that are born 1985 through 1995. They're buying houses right now. So that's the difference, isn't it?
Absolutely. I mean, and the rates are still affordable. You're not, it's not where what Harry's saying is true. Like it's not at 18%. You're not paying what you'd pay on a credit card, right? For these homes, they're still extremely low. So it's still affordable for people to buy houses, and it's more affordable for them to invest in their own future than it is to rent, because the the investors that gobbled up all these properties and, back in like 12 years ago, right? They've, now you're sitting on rent where rent's no longer a viable option. I have a client where the rent's going to be $1,500. She said for $1,500 a month for a 2-bedroom apartment, why am I going to do that when I can now buy something for myself? But the problem is that a lot of people thought that they couldn't afford it, or they didn't know how to save the money, right? So they're having these conversations now. They're being educated. They're learning how to budget. We even had a call on the radio show over the weekend where his daughter's in college, and he's making her pay $500 a month as rent to get her accustomed to paying for something so she doesn't go through life feeling spoiled. But that $500 that he's taking from her whole entire college experience, he's then going to gift that back to her as a down payment for a home. But that isn't a great step because it's preparing her for life after college, because there's a lot of parents out there, they want to do better for their kids. I feel like that's the thing, that you want to be better than what you had. But sometimes it handicaps the generations that are coming up because they don't know what it's like to kind of be on their own. So taking steps like that for your kids, I think, is great. And so I really appreciated that call that came in, because we're able to really kind of solidify the steps that these quote millennials are going to be needing to take when they're entering the market, because some of them lived at home a little bit longer, right? Because they had student loan debts. There's all these things that kind of come into play. But I do think that the rates are going to they're going to remain affordable, even in the 6s. And we're not going to really see a downspin in people wanting to buy homes anymore, because people are getting smarter and they're learning to invest in themselves, not somebody else.
Well, and John Kolb, to Becky's point, there are more buyers out there than from 1979 to 1982. You know, when you were in diapers and I was out in the working world, you know, making a living while you were just, you know, you were playing Lego in your living room with your mom and dad, you know, kind of encourage you along, little Johnny. Rates were at 8%. And I'm sorry, 18%. The difference is people were not buying homes then. The population shift there was a time that due to interest rates, due to lack of buyers in the market, not only because of interest rates, but because the population actually, the birth rate for people 22 years prior to that was down. Okay. So 1979 to 1982, there was a tremendous, there was a tremendous gap in who was buying homes. Now, even if rates go to 6%, you're talking about people that are 22 to 35 to 40, even 22 to 40. There's a lot of buyers out there, John. So, you know, I just don't see a panic. Why is everybody panicking now?
Well, they shouldn't if they listen to our chief nerd economist over there. I mean,
Thank you.
That was
Thanks,
great.
little Johnny.
Yeah, the little Johnny playing Legos. I might just go back down and grab my Legos and Star Wars from the basement right now. There's no reason to panic. It's just a phase in time. If you can't get into a home now, you just might have to wait it out a little bit. It will settle down. Rates will settle down. This crazy seller's market will settle down, and we'll be back to a little bit of normal. And then we'll be in a buyer's market, and everybody will panic. And it's just the back and flow. It's the ebbs and flow of everything that we do.
It is the mortgage business. It is cyclical. Listen, when it's really, really good, mortgages and real estate are really, really good. When it's a little tougher, as Becky said, it weeds the pretenders from the contenders. Harvey Freed, show guest this weekend on 97.1. Before you introduce them, what do you got?
Oh, great. I got two things actually here, and I can wrap you up too. Keith Stonehouse, formerly with Franklin Title Agency with Devon Title, is coming on to give us a little background on title insurance and how that all works and what's going on in the industry. Also, Nick Calty's coming in. Nick's with Remerica United out in the Novi area, and he's been a superstar over the last 3 or 4 years, and we're having him come on and talk some real estate. And then here, if I could just be a mortgage nerd for a quick minute, Becky mentioned 6%, so I thought I'd do a quick comparison. On $100,000, if you borrow it, it's 6%, or at 4%, the difference is $123. So if you borrow $300,000 and it's
It'd be $369, bro.
You did that really fast here. I don't have
Thank you.
Well, there you go. So if you end up borrowing $300,000 and you didn't buy last year this time, and you might end up buying in 2 months from now, the payment could end up being over $300 difference. Now, like as John Kolb mentioned, that's not a deal breaker. So if it is, then maybe you need to reevaluate your price, your price range. So good luck to everyone out there. That's all I got to say.
Yeah, I'm going to leave everybody with this. I'm going to leave you guys with this. Becky, John, Harvey, Roberto Beauchesne in the booth, our producer director. Make sure you tune in to 97.1 FM Saturday morning. Harvey's bringing on some great guests. We're going to talk about title insurance. We're going to talk about real estate, of course, mortgages, probably interest rates. But here's what's going on right now. For those of you who have not been in the market, and this is your first time, don't panic. It's all cyclical. Things are going to settle down. If you don't need to buy a house right now, don't rush into something that you don't need just to get in. I would just wait. But that's my opinion because I'm pretty patient about this. Now, if you're working with a great realtor and you're gone looking at 80 to 100 houses, keep going. Stick to whatever plan works for you. Becky Alley, John Kolb, Harvey Freed, Roberto Beauchesne. Today is Wednesday, April 27, 2022. This has been the Hardcore Podcast. Listen, everybody, just have a great day. Stay calm. And you know what? We're going to make it through this together. It's not that big of a deal. Interest rates in the 6s, not a big deal. We'll talk to you soon.